Hey guys, welcome back. Patrick here. So I hope you had a great Christmas. I hope Santa was good to you and you got a lot of gifts. My gift to you this year is going to be very unimpressive. It's going to be a review on THBR that's going to be merging with Indie Semiconductor. This is a very interesting company. A lot of you have been requesting it. It's very different from what we usually see with the SPAC, so I'm looking forward to give you my thoughts on it. So you guys know how I structure these reviews. I'm going to talk about what was the company doing before, like what are they working on, then the execution plan, what are they going to do after the merger. Then I'll look at the financials and the valuation, and lastly, how am I going to be playing the stock and my thoughts on it. So let's get started with that, but I do have a quick request for you guys. Of course, like and subscribe, but that's obvious. But the other one is a lot of you have been asking me for more exclusive contents and to start a Patreon and all of that. So I would really appreciate if you let me know in the comments or send me an email. What do you guys find valuable? If I start this and I really commit to it, it has to be like high value for you guys. So let me know, what do you actually enjoy from it? Is it like the market updates? Is it getting thoughts on specific stocks and being able to ask questions? What do you guys like? Let me know in the comments or send me an email. I would really appreciate it. Now let's get started with the review. Alright guys, let's get started. So what does Indie Semiconductor do? Well, I want you to go back in time 15, 20 years ago. Everything in your car was mechanical. There was not a single centralized computer that was controlling everything. But now in 2020, going into 2021 and further, I mean, it is very different. The computer in your car controls a lot. So whether it's autonomous driving or driver assistance, the entertainment system, right? This is all controlled by the computer, and now even the car parks by itself. Well, this is going to require more and more computing power over time, and this is what this company specializes in. They kind of bring the brain power to your car. So the main thesis here is that right now there's about $310 per vehicle dedicated to the processing power. This is for level 2.5, like level 3 self-driving. But over time, the goal is to get to level 5, where you're going to be sitting in the back watching movies and watching YouTube videos while the car drives by itself. Well, this is going to be a massive increase in demand when it comes to the processing power. And that's why they think that this is going to make it so more and more money is going to be dedicated to the brains behind the operation. So $975 per vehicle, and then over time, like when we get to level 5 self-driving, we could go up to $4,000 per vehicle. So this company thinks that over time, naturally is going to expand as more and more demand happens in the car industry. So if we look at the basics of the transaction, after the transaction is complete and they have money in their account, they think that the company is going to be valued at $982 million. But of course, this was at the IPO price of $10. So we're going to look at the valuation later on in the video. They're going to have $150 million in PIPE. That's not too bad. And then $345 million comes from the SPAC and is going to be added to their balance, right? So they're going to have about $495 million in cash proceeds, and this is going to help them fund their operations and their growth in the next few years. So one thing to note, and this is what they really highlight, is a $2 billion plus in strategic backlog. So the company is already accredited with some tier 1 providers, and apparently there's a lot of demand for their products. So we're going to look at that a little bit more in detail, right? But just keep in mind that they supposedly have a lot in backlog already, meaning that now they have to kind of fulfill these orders. So apparently Thunderbridge, which is a sponsor of the SPAC, interviewed about 100 different companies before going with Indie Semiconductors. And there are two things that caught their attention. The first one is the backlog of orders, which we'll talk about, but also the suite of products. And this is what I wanted to really look at, is one of the things that the CEO of Thunderbridge mentioned, which is based on all of his conversations with Indie's customers, there appears to be an enormous pent-up demand that Indie is well positioned to capitalize on. To me, that's really important to keep in mind, is that we kind of rely on these sponsors to do due diligence, right? We don't have access to the books. We don't really know what their portfolio looks like, what their customers are and everything. So according to him, when he interviewed this company and he did his due diligence, there is a lot of demand for their products. So their products, right, they started off with a wireless audio chip. And this to me, like, keep in mind that it's not one centralized solution. It is very fragmented. They have different chips for different components of the car. So the first one was the wireless audio. Eventually they worked up to the Apple CarPlay solution, so the entertainment system. Then they're working on the wireless charging, right? So over time, they're just adding more and more to the pipeline. And this is one of the things that Thunderbridge liked. So in the pipeline, they have artificial intelligence, they have the LIDAR. Eventually, they plan on competing, I guess, with Luminar. So design wins, they have the wireless charging, the power distribution. Shipping today, there's the Apple CarPlay. They already have 30 million units of that, so that's great. And then there's the wireless audio. So if we look at some of those products, right, they're in 4 different categories we were looking at earlier. So there's the autonomous driving. In the future, this is going to be pretty huge, right? And then there's the connectivity, which is Wi-Fi system and all of that. The user experience, which is the entertainment system, right? As we were talking about 30 million units shipped, that's for Apple. And then they have 65% of the market share. And then they're also working on the software for electrification, meaning the charging stations. So they're working on chips for that as well. So as you guys can see, like, they're really diversified. They're not really focusing on one aspect. They're trying to cover all the processing power for anything related to cars. So the last thing I want to show for this section is their partnerships. They are accredited with tier 1 providers already. The main ones are, of course, Aptiv, Magna, and then you have Valeo. So right now, those are their biggest partners. You guys probably know Magna already because of the Fisker story, right? They're going to be making the cars for Fisker. So eventually, it's possible that these types of chips are going to be in those vehicles. All right, guys, so now let's get into the size of the market they're going after and their projected revenues. And this is what I'm really passionate about. You guys know this. Companies like these that are extremely small right now, almost insignificant, but have those massive projections for the next several years. So we have to really make a lot of assumptions, and only you can decide if they're going to achieve this or not. Right? I'm looking at it the same way you do. I try to predict in the future, is this an industry that's going to grow? But only you can decide if you agree with their projections or not. So according to them, the semiconductor total addressable market right now is about 33 billion, and it would go to 59 billion in 2025, right? So it's almost going to double. And with this company having approximately $1 billion in valuation right now, they have a lot of room to grow still. So according to them, their current total addressable market, like specifically for this company, is 16 billion in 2020, and it would grow to 38 billion in 2025. Through their 4 different categories we're talking about, right? The connected car, that's like the Wi-Fi and all of that, the cloud, and then you have the electrification, that's the charging stations, safety systems, and then the entertainment system. So those are their 4 categories of growth, and they do think that over time, those are just going to expand. But here's the thing, right? They're talking about right now, they have a $16 billion total addressable market. That sounds great, but when you look at their actual revenues, $23 million. Like, so they are pretty much insignificant in this industry right now. And also, like, in 2019, their revenues were also $23 million, meaning that they had 0 growth in the past year. Now, what do you want to do with that? I mean, like, you have to keep in mind that these are just projections for next year and the year after that. We'll see if they're able to deliver on those, right? But what's going to make them grow from 23 million to 44 next year and then 91? So compounded annual growth rate of 85% in the next 5 years, right? So they have the 2 billion strategic backlog, which according to them, and this is what, like, if what they say is true, is pretty good, is the fact that they do have 70% of their 2023 revenue in strategic backlog. We'll see the definition in a minute, right? But these are contracts that they actually won. So yes, they only have 23 million for 2020, but with the contracts that they have won, which they are supposedly going to be delivering on next year, that would bring the revenues to 44 million next year. And then they already have those won for 2022. Bringing it to 91 million. And then this is in 2023 is when it's more about their pipeline, right? It's not necessarily contracts that they have right now. It's contracts that they think that they can get. So pipeline represents a highly qualified opportunity with current customer of an existing or new product in development. So they don't tell us exactly like what's their percentage that they have won already. They just tell us the maximum that they can get would be 204 million for 2023. And then in 2024, that would go up to 349, and then 501 million in 2025. So these are projections based not on contracts that they have right now, but on assumptions that they may be able to get contracts. And if we go into like really detail, this is how they actually qualify the strategic backlog and pipeline. As used in this presentation, strategic backlog means projected future revenues based on existing contracts, setting forth design and pricing terms, and historic production trends of our customers. That's the important part, right? Is they assume that this is based on historic trends for their current customers. They're going to order this amount. The only thing you can really take into account is the contracts that they have won right now and your assumptions for future contracts that they're going to get. All right, so if you look at the company's financials, this is where it gets a lot more exciting and positive. I said pretty much the same thing with Luminar, and look how that turned out. Companies like these that have both software and hardware have a big advantage. The hardware part is not where the money is made, right? It's in the software. That's where the good profit margin is. So they're not going to be making a lot of money selling the hardware itself, but their profits are going to come from the software. So if we look at it, right, their total revenues in 2020 are only 23 million, and they're actually losing money right now because of R&D of 20 million. They have to invest a lot of money researching and developing these new chips for these different components. So right now they are EBITDA negative 17 million for this year 2020. But this is only going to improve a lot over time, right? Even if you're very conservative with your growth numbers and you're saying, well, I think that they're not going to get that many contracts and everything. Well, still, because of the fact that they're going to scale up and have much better profit margin on their software, it is eventually probably most likely going to lead them to at least break even or turn a profit. So as you guys can see from the profit margins here, like this is fairly conservative. 40% in 2020, and then they think that they can increase that to 59.5% in 2025. Well, this is even more conservative, lower than what Luminar had projected at 64%, I believe, if my memory serves right, but something around there. Right? And if we look at their R&D, yes, it's going to go up every year, right? They keep having to reinvest in developing more products. So 74 million, 81 million, 91 million, and then 99 million, but it's not going to grow at the same pace as the actual revenues. And that's why over time, instead of losing money, they are going to start like at least breaking even or making profits. So according to them, in 2023 is when they would be EBITDA positive, only a small 3 million. But then as they scale up, right, they're going to bring their costs down, the revenues are going to be up. And then by 2025, they could get to 154 million in positive EBITDA. And this, as I mentioned, is fairly conservative. I mean, you can see a path to get there. So getting into the valuation now, the company as of me filming this would be worth about $1.39 billion. To get to that number, you take 144.7 million shares after the merger, multiply that by the current share price of $12.85, then you subtract the 465 million that they're going to have in their bank account, and you get $1.39 billion in valuation. So for this transaction, the pipe is going to be 150 million, right? And that's going to give them 10.4% of the company, as opposed to 345 million for the SPAC, which is going to lead to 23.8% of the company. Now, this is pretty good. You want the pipe to be as low as possible. We've learned over and over again that they pay $10. So if the share price runs up to $20 eventually, right, or something like that, it gives them a big incentive to sell some of their position and cash out over time. As opposed to the shareholders, let's say that you bought at 18 and now the share price at 20, well, you're not going to be selling. So having a smaller pipe, in my opinion, right, is good for the company, but it's also good for the investor. That's just how I see it. So if we look at their comparisons with other peers, this is where, again, you have to really make your own decision on if it's good or not. If you compare them with chip makers in their industry, they're doing great, right? 99% compound annual growth rate compared to all the other guys in the 7 to 22% range. Gross margins better, the EBITDA is better, but the company wants to be compared with LIDAR companies because that's one of the avenues that they want to get into in the future is compete with LIDAR. And they're very average, like middle of the pack, right? If you compare them with Ava, Luminar, and Velodyne, they're not really better at this point anyway. So 2025 revenue compounded annual growth rate. So they would be at 85% compared to 181% for Ava and 124% for Luminar, but slightly better than Velodyne at 61%. Then if we go to gross margin at 59% for this company, lower than Luminar at 64 and Ava at 63, but slightly better than Velodyne at 58. And then if we go into the EBITDA margin, they would be at 31% compared to 44% for Luminar and 39% for Ava, and slightly better than Velodyne at 22%. So what does that give you? I mean, like, do you want to invest in this company or invest in one of the other specific LiDAR makers that are like really done well over the past few months? Now keep in mind also though that Luminar is a company that ran up a lot. So in the, like, if the share price doesn't really go up too much, it's going to compare favorably because of the valuation. But in the end, like according to their own projections, they should grow slower than some of these LiDAR companies. So this is where you can actually see, this is the last chart we're going to be looking at. Key semiconductor peers. The actual multiplier in 2024 would be 2.8x compared to these other more stable players that are between 5x and 13.1x. But if you compare them with the actual LiDAR companies, right, they say that they would be a 2x multiplier, but this is based on the $10 IPO price. Now it's already starting to go up. Compared to Luminar at 8.7x, Velodyne at 3.4, and Ava at 2.4. So once again, like, why would you go with this company over some of the other ones aside from the valuation? All right, guys, so in the close, let's talk about my thoughts for the company and how am I going to be playing it? Where do I see it going? Well, first, let's say that the SPAC market right now is absolutely on a tear. Everything is going up. So it's not necessarily about, is this company going to go up? Because I'm pretty sure it will, but it's more about, is it going to grow up more than other companies I could invest in? And here I would say probably yes in the short term. I do think that this is going to be a very good short-term momentum play. The company ended the day at 1285, but after hours it was already pushed up past 13. So to 1338, and I do expect that it's going to keep going up. It has a lot of meme characteristics, and we've seen in the past month, like with companies like QuantumScape, that's basically all that matters right now in the short term. Is the company in the electric vehicle industry? Do they have technology and like LiDAR, stuff like that? This just appeals to people's imagination and they're willing to really invest all of their money into these companies. They don't really look at valuations. They don't look at the long-term potentials. It's more about the now, and people right now are willing to invest in these companies. So for me, it is a short-term play. I am going to be investing in the company, right? I do think that at 1338 and the warrants, which we'll look at in a second, are still okay. I mean, not the best, but pretty good. So I am going to open a position in this company. Now, right now, you want to look at it and compare it with a company like Luminar. I like Luminar a lot better than Indie, right? But the problem with the company is the valuation. Luminar is at 10.7 billion compared to Indie Semiconductors, which is currently at 1.39 billion. So that makes Indie a lot more attractive in the short term than Luminar, even if long term we think that Luminar is going to grow faster and be more important in their industry. So keep that in mind. Like, the valuation really makes a big difference, because what's more likely to happen? Thunderbridge doubling to, let's say, $25, and the valuation going from 1.39 to, let's say, 3 billion, or a company like Luminar doubling from 10 billion to 20 billion. Well, obviously, it's much more likely that this company is going to double, and that's why, to me, in the short term, it's a better investment. So that's how I see it, right? I'm going to open a position on this. All right, before we go, let's take a quick look at my trusty spreadsheet. I know you guys really appreciate it. First, let me say that Indie at 1285, as you guys can see here, I think they are at the inflection point where there is some room to really grow over the next week or two, because there is the next best thing factor at play. What I mean by that is right now, the SPACs are going up so quickly. If you blink, you missed it. So a lot of them, the ones that are really attractive, they're already bid up already. So there's always going to be people that are looking for the next best thing to invest in. And in this case, it's probably going to be companies like THBR, Indie Semiconductor. So I do think that over the next week or two, unless there's a complete 100-degree change in the market, this company is going to grow. So right now, the warrants are 357, right? That is very average. They've been bid up already. That's not a big discount compared to other companies. The leverage ratio is 360, meaning you can buy 3.60 warrant for every share, right? So it's still decent. There is room to make more money with this, but you know, it can or it might not. If we compare it with Ava, which is one of the companies we talked about in this video, right? IPV, the share price is at 1776. It's a LIDAR company, and then the warrants at 450. So if you compare the two, you can see that Indie Semiconductor probably has room to grow because no one looks at the valuations. They only look at the share price and the warrants price. So guys, in the end, in the conclusion, I just want to say, remember, these videos are only for entertainment purposes. I'm not always right? Recently, we've had massive success, but I've made mistakes in the past too. And this is not advice. This is just chronicling what I'm doing. Please don't follow what I'm doing. Do your own research, consult your own financial advisor. And I really appreciate you watching. I'll see you guys in the next video.